We're going to go ahead and get started with our introductions. And I want to welcome you all to Financing a Business. I have our very own SCORE Boston mentor, Shankar Hegde. And this webinar is being shared amongst our district chapters, and I'll go into that a little bit more later. And we have a sponsor with us today, East Cambridge Savings Bank. And they'll do a short intro at the beginning, and then we're glad that they will be on with us at the very end to take more questions about the bank. I actually have two different folks represented from East Cambridge Savings Bank on this slide, but I have Robert Nichols and Debbie Dobbins with us today to answer questions. So let me just start with SCORE a little bit. SCORE offers training for those that are thinking about starting a business, in the process of starting that business, or are in business and trying to grow their business, or working through different business related issues. The most important thing that SCORE does is mentoring. Our mentors are volunteers with different experiences and backgrounds and knowledge that they want to share with you. So please consider getting a mentor to help you through the different business situations. I do get a lot of questions about what happens on a mentoring session and what I need to get a mentor. You do not have to have a business plan already, and you don't have to have a registered business to meet with a mentor. Sessions run 30 minutes, 45 minutes, sometimes maybe even an hour. A lot of them are on Zoom, although we are phasing in more face-to-face sessions. And the first session is going to be about finding out where you are in the process and what your goals might be, and coming up with a plan to help you achieve those goals. And the mentor is there to work with you and help you get that information organized and to have clear progression on your path to your business goals. Okay, so if you're interested in a SCORE mentor, there's a couple different ways to do that. You can put a note in chat and I'll make sure the right chapter reaches out to you. You can also go to any of the SCORE chapter websites listed here, and I will put those into the chat so that you can find that information easily. Today, we do anticipate a large number of people on the call. So I very strongly encourage you to use the Q&A tab to enter questions that you want asked to our presenter or to the bank. So that way we can keep those questions organized, because sometimes they can get lost in chat. You're welcome to use chat for anything else, but if you could please put those questions in the Q&A tab, that'll help us keep those questions organized. Like I said, we do anticipate a lot of people. I'm going to go ahead and introduce Robert Nichols from East Cambridge Savings Bank. And he's going to talk a little bit about the bank, and then we'll be turning it over to our presenter.
Thank you, Teresa, and thank you everyone for joining the webinar today on the topic Financing a Business. SCORE has been a great partner to work with, and we continue and are willing to provide these outstanding workshops. East Cambridge Savings Bank is a mutual savings bank. We are not a publicly traded company, and we do not have investors. Mutual savings banks have been around since the early 19th century and are still common in New England. Our bank was founded in 1854 and has been operating with the same name and charter since then. We have never been acquired or sold to a larger bank. Since East Cambridge Savings Bank is a mutual bank and does not have shareholders, we reinvest profits locally through mortgages, loans for small businesses, and supporting nonprofit organizations. Thank you, and back to you, Teresa.
Okay. All right, well, I want to go ahead and introduce Shankar Hegde. If you want to go ahead and get your presentation up, you're ready. We're ready for you to take over. Thank you.
Okay, just a minute. Okay, Teresa, can you see this?
Yeah, you're all set.
Okay, all right. Just before we start, a little bit of introduction. I have been with the SCORE for about 5 years. Before that, I worked for a couple of big companies like AT&T and Arthur Andersen. And then I worked for a couple of startups. Then I started my own. So I had two businesses, one in consulting, one in product. So I have gone through all the stages of a startup, including writing a business plan, looking for venture money, and obviously going all the way to exit. So what I'm talking to you today is pretty much from my experience, but the sources for financing have changed. So before I get to sources of financing, let's look at the agenda here. First, why do people start businesses? I want to go through that. And then people think only one way to start business is to start a business. But there are a couple of more ways. I'm going to talk to you about that. And then we go into financing a business. No matter how you start a business, no matter what kind of business you are in, the financing sources are the same. Then I will give you a little bit of funding statistics. This was done by SCORE about 2-3 years back. We did survey about 1,000 startup businesses. So the funding statistics is relatively recent and accurate. Then we open up with questions and answers. Okay, why do people start businesses? Believe that they have a unique product or service that will be valuable to other people. So sometimes they want to be their own boss, because many people I do counsel, they said, I'm tired of my boss. That may not be the right reason to start a business, but people do start a business because of that reason as well. But really, people who are successful want to build something new, build something unique. And then obviously everybody says, I want to get rich, because they always have this Jeff Bezos, Zuckerberg, Bill Gates, recently obviously Elon Musk. But you may not be able to get that rich rather. But yes, at least you can make a good living. That's the purpose of starting a business. Want to build a lifestyle business? I mean, that's really a good thing to do, because nowadays the YouTubers, right? I mean, you hear them. So YouTubers, maybe they are specializing in travel. There are so many cooking channels, unbelievable. But I do hear that depending on the number of subscribers and number of hits, you can make a really good living. And also it fits your lifestyle. Again, to sum up, there are many kinds of businesses: products, services, professional services, as well as non-profits. So 3 ways to start a business. One is start from scratch. I mean, that's, I think everybody love to do, right? You want to start from scratch. But you can always buy an existing business, or you can license a brand or a business that's called franchising. Let us take a look at each one of them. So starting from scratch, obviously advantage is you have a total control. You make all decisions, you keep all the profits. There is a bigger upside. However, the disadvantage is you have to create what they call operating or operation systems. You have a high failure rate. 1 in 10 may succeed. There are quite a few years, maybe 3 years to 10 years sometimes, before you make money. And then I am going to go through a bunch of financing options. But once you get into that, you know it's not easy to get money. So I did go through that as well. But there are limited financing options, because many of these VCs, venture capitalists, and they all will fund you if you already have started another business. But if you are starting the business the first time, it's not easy. So how about buying an existing business? So sure, I mean, you know the cash flow, or at least you know what is in the books. and you have the historical result, and you can always get a loan attractive to lenders, and you know the location, and you will have the customer base. And sometimes even the previous owner will do some financing. But disadvantage is you really don't know until you start owning the business what will be the real cash flow. I'm not saying that the books are not right, but your cash flow may be different than the historical result. And you will never find out what is the seller motivation behind the seller. And it could be that once you own the business, the current employees may go somewhere else. And also you have to hire new employees, then the training, and you may not be getting the best training material from the previous owner. Okay, how about then licensing a business or franchising? Clearly, there are some good businesses or franchises. They're a good name. Dunkin' Donuts, it's one thing it comes to my mind. There are big ones, obviously, McDonald's, Burger King, Wendy's, you name it. So the big ones have a name recognition, and they have business systems or operating systems to start and operate the business. They have good training materials. And obviously, if you go with the brand names, there is a very low failure rate. However, the disadvantage is you have to stick with their business model. You have to stick with their operating systems. And obviously, there are some territory restrictions. You can operate only in the region you are licensed to operate. And obviously, you cannot keep all the profit because there is an ongoing royalty payment. Okay, so no matter how you start a business, the first thing you can do or really have to do is put in your own money, some of your own money. So you can tap into the savings or other liquid assets. And obviously, credit card, I don't advise using the credit card, because if you are late paying, then they will slap you with 20% probably interest. There is, if you have a home, and then there is obviously nowadays there is quite a bit of equity built into, so you can always go for home equity loan, easier to get than the traditional loans, and sometimes probably lower interest. I don't know about now. Maybe it's the same interest as other loans. And also you can get some personal loans from the bank. Then you can always reach out to your friends and relatives and get them put in some money in your business. So that's another way of financing your own business, at least a portion of the money that you need to operate. So once you do that, you can always go for what I call ecosystems. I'm going to outline 4 of them. One is a business plan competition. Then there are a bunch of grants. And there are what they call incubators and accelerators. And then I think very familiar, at least people have heard about crowdfunding. So let us take one at a time. Business plan competition. I'm outlining some of the local ones. If you go to some other state, there are different ones. Most of the business plans are operated or really by universities. Locally here is MIT 100K entrepreneurship competition is very popular. HBS has a couple of them. HBS is Harvard Business School. I'm outlining here a new venture competition. Babson has a couple of programs, Dartmouth, BU, UMass Innovation Challenge. Then the last one is UPitch, U.Pitch. It used to be run by universities. Now, if I can click on this one, now it is run by, I think it's private. So they run by private, but however, they are open to, there is a way of accessing this one, applying this one. So what I'm saying, they're open to anybody and everybody, okay? Hold on a minute, let me, something happened here. Hello?
Yeah, we can
Hi.
hear you and I can still see your screen.
Oh, okay, something happened here. It's just my screen. Can you see me as well?
Yeah. Mhm.
Okay, all right, let me go on. So the other organizations are American Chemical Society, Draper Competition for Women, and the Global Student Entrepreneur Awards. Global Student is obviously open for all the countries. It is held annually. Okay, the next one is the grants. The first, there are quite a few for specifically for women. The Amber Grant is every year. It is offering a 10,000 every month and 25,000 annually in grant monies. The Alice for minorities and women, helloalice.com, it just started a couple of years ago during COVID time. And again, this is specifically for women. And Girl Boss Foundation is specifically for Black women. Again, you can go into all the details here. If you can click on that, let me see whether. Okay, so this is just like the Girl Boss Foundation, and it tells you what it is, and then you can apply right here, how to apply for Girl Boss Foundation, apply codes, and everything is online. Okay. And the next one is FedEx. FedEx gives 15,000 to 20,000 to 50,000, 15 to 50, and again it's every year. NASC is the National Association for Self-Employed. It is about 4,000 grant awarded to companies and has awarded nearly 1 million in grants every year. Then the Cartier Women's Initiative Award, even though it's a watch company, it's open for everybody. Then the Halstead Grant is for jewelry designers, for female jewelry designers only. And then there are quite a bit of state grants. Let me tell you a little bit of on this one. Okay, this is a database is done by what I call a C2ER organization. I remind you, in order to join the C2ER and access all the things, there is a membership fee of $362. So once you pay that fee, you can use the resources of C2ER, which is a subsidiary or is managed by another organization called CREC. So you can access all this grant information from this site. Then the federal grants, again, let me just go into the federal grants. This is free. Okay, you can search and you can search for any grant in any organization. All kinds of organizations are offering the federal grants. And so this is called grants.gov. Okay, now the next one is really, this is all federal grant, specifically SBIR and STTR, Small Business Innovation Research, Small Business Technology Transfer Research. So only difference is SBIR, you can apply if you are a for-profit company and you can apply your own. STTR is you need to collaborate, you need to partner with another organization. Usually the organizations are many of those universities. So STTR, you need to partner with a university. SBIR, you do it your own. So if you can look at this one, there is in fiscal year 19, I think it all went up now. DOD is the largest for SBIR. They awarded about $2 billion in SBIR, STTR grants. And then the NIH comes next, Department of Energy, National Science Foundation, all the way down to EPA. Again, these funding amounts may be different each year. I did get a few years ago when I worked for a startup company, I did get a $3 million contract for 3 years from Department of Commerce, really as a part of NIST. This is the second from the bottom. Once you get the grant, it's easy. You really do what you're supposed to do in the grant, and then you have to write a report once a year. So it's not a whole lot of bureaucracy at all once you get a grant. You want to get a grant, any of these grants, it's really a simple process. We applied for SBI grant, and obviously they do call you for an interview in Washington, DC. And then within a few weeks, you know whether you won the grant or not. So they really have streamlined all these grants now, and anybody can access online. Okay, the next one is incubators and accelerators. What is the difference? Incubators really are the associations or units that work with you when you have just an idea. And they do provide you the funding, they provide you the facility, and you work there, and they will have mentors. So really they are going to incubate your idea, your organization, your company. So accelerators are really, once you have this incubation done, you are at a certain level, so you can always get the accelerators to help you to accelerate your business growth. However, what is happening is the differentiation is kind of not there anymore, because incubators can scale up your business, and sometimes the accelerators also will start up with you when you just have an idea. So again, there are some local companies I've given you here. Mass Challenge is one of the big ones. Y Combinator is everywhere. Code Launch, Harvard Innovation Lab, they call it iLab. MIT Global Startup Labs, and another one is Cubic Labs. Again, you can look into the details here in the link I have provided at the bottom. Okay, crowdfunding. Everybody had heard about crowdfunding, at least GoFundMe, but there are quite a few other ones. I have outlined half a dozen or so here. And let me tell you, each one has a little bit of a different business model. And so you need to really go through what is the right thing for you. For example, Kickstarter, okay, has a campaign. And suppose you have raising, or your goal is $1 million. It's all or nothing model. What it means is you won't get any money unless you reach $1 million. And then they take anywhere between 3 to 5% of the money you raised. Indigo, oh, by the way, Kickstarter really, will fund you if you have some kind of a product, what I call a gadget. Indiegogo is not all or nothing. If you raise, say, 300,000, you have not met your goal, but you get to keep the money. And again, their pay, they will also take similar amount of money from you as Kickstarter. And Mighty Cause is really for nonprofits as the Patreon. And GoFundMe is obviously for if somebody dies accidentally and their family is in need of money, a person can put up a GoFundMe and then raise the money that way. But again, GoFundMe is not for any product development or for service. Then again, there is a circle up. So if you can click on this one. Okay. Again, best overall, this is the rating done by this platform. This is a Kickstarter. Runner-up is Indiegogo. Best for creators, I was wrong. Patreon is for creators, which means artists, pretty much predominantly artists. And best for personal, as I said, is GoFundMe. Best for small businesses, there is a new one called Fundable. Best for nonprofits is Mighty Cause. And Seed Invest is the seed stage companies. Best for high growth startups is called Start Engine. Again, all these things, oh, I was wrong. The platform fee is 5%, and then they take anywhere between 3 to 5% of each transaction. This is for Kickstarter. Indiegogo is the same thing, 5% platform fee. Patreon is between 5 to 12% of your monthly income, depending on your Patreon pricing. So everyone takes a little bit chunk out of your what you raised, so that they can proceed or they can keep working for you. Okay. Now let's switch gear. There are a couple of other ones, funding options. One is loan, what I call a debt financing. The other one is equity, then I'll get to that one pretty soon. So the debt financing is, the first one is a bank loan. There are different types of bank loan. One is a revolving credit, then they give you the money for working capital. Then a line of credit, this is line of credit is, suppose you get a line of credit for 100,000. So you can use whatever you want to use. They will charge you the interest only on the portion of the money you take out. So if you take out 30,000, you only pay the interest on 30,000. Then you still have 70,000 left. And line of credit is that way different than other types of bank loans. However, banks always want some collateral, and they obviously want some decent your credit score. Each bank is different, but there is a decent credit score. They do check your credit score. But if you don't have a really good credit score, then there is a set of companies called peer-to-peer lending. Again, there are a bunch of them. Peerform is one of the big ones, and the Funding Circle, and then again, there are quite a few of these ones. And they do charge a little bit higher interest compared to the bank loans. So you have to be careful about how much interest you pay. You can, again, shop around. This is not just one company, there are quite a few of them. Now, another way of getting the loan really is equipment leasing. This is if you are in a big industry, construction industry, and you are paying a lot of money for the big equipments, then you can have lease terms. So, you have 3-year lease, 10-year lease. So then you pay the installment. So that's equipment leasing. The other type of debt financing is really receivable financing. Suppose you have 100,000 receivable, but then you have some terms. So you may not be getting your 100,000 in 3 months. So depending on what kind of a working relation you have. So if you need the money right away, you cannot wait for 3 months. Then there are some companies that they give you or they loan you the money till you can get the receivables, and then you pay them back. So this is really a short-term loan. You don't want this for years and years. So it's really until you get your receivables, you have a short-term need for cash, then you go with that. receivable financing companies. Now, the last one, but not the least, is SBA and Small Business Administration. Okay, how does the SBA loan work? Okay, SBA only guarantees the loan for the banks, and SBA does not provide you the loan. So, what is the process? Your borrower applies at the bank, and bank decides, and if bank wants to give you the loan, then it goes to the SBA as a SBA guaranteed, so that the loan will be done by the bank, and the bank will fall back on SBA if somehow the bank cannot collect the repayment from you. So for that, bank will have to provide some fee back to SBA. But you deal with the bank, and bank underwrites the SBA policy. And then if the loan is approved, bank will do the closing, and also you have to pay back the money to the bank. So again, at the bottom, the borrower works with the bank, not SBA. Okay. So again, you may ask, why do the lenders use SBA guarantee? Okay, because your collateral may be inadequate. You may have some collateral, but it does not meet banking requirements. And some startup companies or some businesses may be too high risk for the bank to go alone. And that's the reason it had the SBA guarantee. And the bottom line is banks want to minimize their risk. Again, the terms are flexible maturities up to 10 years for working capital and up to 25 years for fixed asset. Again, the interest rate is negotiated between the borrower and the bank. And however, the banks have some limits, or really typically it cannot exceed the prime rate plus 2 3/4. So what banks look for? Bank looks for owners or people who want to start business with obviously good credit. And they do look at the business plan, and they do look at the cash flow. And many times we review the business plan for the SBA for that. So yes, you need to have a cash flow and a business plan. So we look for business plan, and we'll see whether it makes sense, whether the business will return enough profit so that you can pay back the money, and whether you have a team in place, and whether there is equity investment in the business from the owner. And also the bank look for a collateral. So as I said, will the loan repay from the earnings of the business? So that's why the cash flow is critical. Again, to be eligible for the SBA loan, business must be operated as a for-profit. However, there are some SBA size standards. That depends on what kind of business you are in. Some size may be as low as 5 million and 50 people. Sometimes, the size of your business, if it is in I think it's a construction, I think it goes up to something like 30 to 70 million. I haven't looked up recently, but you can look into the SBA size standards. They have enumerated the number of employees as well as the revenue for the business, depending on what kind of industry you are in. And obviously, they don't give you the loan for reinvestment, so that you cannot get the loan and invest in stock market. They don't give you the money for real estate development or any kind of a speculative investment. So you really have to spend the money on the business that is identified in your business plan. Okay, there are quite a few other, this is called a 7A loan. This is the SBA's primary business loan program. As I said before, it's 5 to 10 years for working capital, 25 years for real estate construction, prime plus 2.25 for 7 years or less, 2 3/4 for loans over 7 years. Program guarantee, this is the program guarantee fee. This is the fee that the bank charges to the SBA. Okay, in addition to the previous loan program, there is another one. It's called 504 CDC. So the way it works is, look in the pie chart here. Suppose you as a business owner, you put some money. It's a 10%, and the bank will make up the difference between your money and the CDC contribution. So in this case, CDC, which is Certified Development Company, we say puts up 40%, then the bank will put up the rest of the 50% of the money. The limit is 5 million, okay, and the guarantee is really for the 100% of the SBA portion of the money. Again, this is for long-term fixed asset. Maturity is 10 to 20 years. Only exception is for 5.5 million for green projects. Okay, again, there are some of the eligible users for 504 loan proceeds, and ineligible use, again, as I said, you can't be using it for a lot of other things like a franchising fee, moving costs, rolling stock, and you can look at all the details in the SBA page as well. Then in addition to that, then there is a SBA microloans. It's a loan up to 50,000. Interest rate is 9% fixed. It used to be, maybe a few months ago. I had to look it up again. It might have gone up. I don't know yet, but around 9% fixed, up to 6-year repayment. And funds can be used for working capital, inventory, machinery, even furniture, or for refinancing a business. So this is a micro lending facility. Now, let me get into different type of financing, what I call equity financing. What that means is for the money you get from the institution, they take a percentage of your company. So the only way they make money is when you exit. What that means is either you sell your company or you go public, which is called IPO, initial public offering. Then the institution gets the money.
I would like to propose.
Can you hear me?
Yeah, I think Debbie needs to, we'll get it. Yeah,
Okay.
I'll fix it.
Okay, all right. I can go on, right?
Yes, keep going.
Okay, all right. So they want you to succeed, because unless you succeed, they don't get any money back. So it is a risk investing from the institution point of view. But however, reason they are surviving and they are thriving is, one, even if they make 1 in 10 companies survive, that one company could be Microsoft, one company could be Amazon, one company could be Apple, or one company could be your own business. So they make all the money they lost in other companies, plus some more. So they want you to succeed in one way or the other. And that means either you can sell your company, or you can merge with another company, or you go public. So equity financing, let's start with the basic, right? Suppose you are the only one in the company, you have to have all of your money invested. So you own 100% of your company. What if you get another person, say he invests 50% and you invest 50%. So then he gets half of your company. So you own half and he owns half. So you can have 3 partners. I don't recommend more than anywhere between 2 and 4 partners. Otherwise, one too many. So that way, your partner will put in some money, and in return, he or she gets a percentage of the company. So again, how do you guys, both of you guys, make money the same way? Either you sell the company or you go public. Another way of equity financing is, suppose you have a product you are selling to a customer. So the customer, in this case, the customer could be another company, and they can invest in your own company. In return, they do own a percentage of your company. Sometimes this is the best option, really, because in addition to the customer, that institution can pitch in some money, and together you want to make sure that you go big and you sell out or you exit. So the other option is what I've been saying is the IPO, initial public offering. Yes, you do make money after the what they call a lockup period. Usually it's about 6 months. You cannot sell any of your share of the company till 6 months. And then after 6 months, you can sell a portion of your equity. So, but the main purpose of IPO, going public, is really not to get rich, but to raise money so that you can grow your business. That's the main purpose. Suppose you get IPO, you are say 100 million. So you have to put that money back into your business to grow the company. And by the way, IPO is a mechanism where your partner can get out, or really, if you have money from other investors, those investors can cash out. So this is the mechanism for cashing out, but the main reason is get the money in to grow the company. Now, there is the other option is what I call a private market as opposed to public market. IPO is a public market. So private market, there are a bunch of investors. I categorize them into 3 categories. One is angel investors. Then the other one is venture capital and private equity. But for many of people in the audience, I think the angel investors is probably the attractive. So let's go to the angel investors. Okay. Angel investors could be just one individual person who has money to invest in your company, or some of the investors kind of pool together their resources, the money, and they kind of have this LLC, and they have a process. There is an application process, and there is a process to review your application. They usually invite you back in, and then they make a decision to invest or not. So the Boston Harbor Angels and Thai Boston Angels, I was a member of that committee. In fact, I was a deal manager. What that means is I was part of the reviewing the application, and I was part of the meeting where the investors make a decision. So I was doing the deal flow end to end, as well as, and obviously working with the investor to do the term sheet. So then there is a Launchpad, Cherry Stone, Landmark, Northeast. The last one is Golden Seeds. The reason I'm talking about Golden Seeds is this is specifically for women only, women entrepreneurs. The rest of them are open for anybody, but the Golden Seeds is only for women. The angel investors usually invest, not necessarily, invest anywhere from 100,000 to a couple of million. Some of these angel investor groups can go higher, and some of the angel investors, individuals, maybe even go lower, maybe 50,000 to $1 million. So there is a wide range of investment depending on the company that they are investing in. Again, Each one is different. So before you apply, you should look at their portfolio. For example, Thai Boston Angels, they invest usually in the high technology. And so you need to have some kind of a combination of software and or hardware. That's the focus of angel investors in Boston, Thai Boston Angels. However, take a look at the other investor groups, and they usually have their portfolio online. So you should look at what kind of a portfolio you would be fitting in, what kind of an industry group your group is going to, or your company is fitting in. Now, the next one is venture capital, and then there is a private equity. So the VCs, how do they differ? So VCs and PEs, they differ in the type of company they invest in. VCs usually invest in the startups, whereas the private equity invests in the mature companies and the big companies. Then the levels of capital invested, again, VCs invest anywhere from 1 million to say 5 million, whereas the PE, they are into big investments, $1 billion and above. Usually what the private equity does is if the big company is in trouble, or if they think the big company stock is so low, it's a good attractive buy, they put in the money, and even though it's a public company, they will put in all the money, they take it from public to private. And what they do, PEs, is once they take public, and usually what they do is they optimize the operation, they cut the cost. Many times they merge this company with some other company which is doing a similar business, so that the size matters for them, the scale. So bigger the company, obviously they can probably turn it around and they can sell it for a profit. So that's the focus of PE. Again, the amount of equity they obtain through the investment, VCs, usually they don't invest 100% of the company because they want you to keep, sometimes they want to keep you majority, so means they will invest less than 50%. Many times the VCs, they invest maybe 5%, depending upon what your requirement is. However, PEs, as I said before, they do buy the company. That means they invest 100% of the market market rate or market appreciation, market evaluation rather. Again, the last one is when they get involved during a company's life cycle, right? VCs involved early when you are just a startup. PE involved in when you are a mature company, you have been operating for quite some time. Okay, VCs, again, I'm outlining some of the local ones. Mass Ventures, Atlas, Bessemer, Highland. Some are big ones, some are not so big. So if you're interested in that, obviously you need to have a business plan, and you need to have some kind of a product prototype, whether it's a software, hardware, or any other type of business. So you need to have some, you should have, or you must do some progress in your company to a certain extent. So then it's attractive to VCs. Okay, private equities, again, half a dozen or so I outlined here. You can Google them and you can look at other private equity companies as well. Okay. So now, okay, let me go into funding statistics. Again, we interviewed or we surveyed 1,000 small businesses. This was done a few years ago. Startup entrepreneurs rely mostly on the personal savings and income for funding. So almost 63% of the companies, they start with the personal funds. And then another 27 or so income from another job. So if you look at this statistic here, 11% of companies borrowed from the friends, 11% bank loan, 9% from credit card, even though I do discourage that, 6% from donation, 3% investors, and 2% grants, and about 2% in crowdfunding. Look at the statistics at the bottom. 42% of entrepreneurs started with less than 5,000 in cash reserve. That's the really encouraging, I guess. And 49% started out with 10,000, and 24% started out with more than 50,000. So how did they use the money? Most of them, 63% used it for purchasing the equipment, purchasing the inventory goes next, marketing is about 48%, and all the way down product development about 27%, paying the own salary 23%. Again, remember, you need to pay yourself during this process. So whenever you do a business plan, whenever you go for VCs or for angel investors, one of the line items should be how much money you are getting during this process, right? When you're operating the business. So you need to have a decent salary so that you don't have to worry about at least a day-to-day of your requirements, so that you can focus on your business. So with that, I think, Teresa, I'm done with the presentation, and we can open up for questions.
Yeah, I strongly encourage you to get your questions into the Q&A tab. If you do prefer, you can use the raise hand icon, and I will open your mic so that you can ask your question out loud if that's easier for you. Yeah, so the first question, we actually came in early on when you were talking about the business plan competitions. Do you know if any of those would work for somebody that's trying to open a restaurant concept?
Restaurant, you said?
Yeah.
Absolutely.
Okay.
Oh yeah, absolutely. There's nothing wrong with the restaurant at all. I mean, you need to have the cash flow and the business plan and everything else. Yes.
Okay.
Yep.
Okay. What method of funding, this might be for you and for potentially one of our bank people. What method of funding would you recommend pursuing for a business that is already operating, but is not in a positive cash flow yet, and where the owner capital is just about gone, so time is an issue?
When you say time is an issue, depends on how much money this person is looking for and what is the time frame, right? If you are looking for little amount of money, 15,000, 50,000 or things like that, and if you have say 3 to 6 months, and depending on the business, grants could be an option, or the federal or state government grants could be an option. Angel investors, if you know somebody, that's another option. Or really, I would say best way is to see whether you can call up a friend or a relative or anybody that you know can invest. I mean, that's probably the fastest way. But really, anything and everything takes time, and anything and everything takes effort. So if you are in a hurry, I think the best and the quickest is really see whether you can get somebody that you know can invest at least a stopgap.
Okay. And then if any of our bank people have anything to add to any of these questions, please feel free to unmute at any time. Okay, next question is, would you recommend more than 23.6% to pay yourself, or does it depend on how much you take in weekly?
23%, they are just statistics. To pay yourself, I mean, you need to be reasonable amount you need to ask for to pay yourself. So what if you are working outside, say you are getting 50,000 or 100,000 a year. So in order to have a reasonable amount of lifestyle, that you have to ask what you would be making outside. So if you are making 100,000 before you quit your job, you should ask for 100,000 a year in your plan, and you should be getting that much amount of money.
Okay. Next question. If an individual can access a 100K personal loan on their own due to their high, good credit score, then if they become a partner, would they get as large loan as a business then if they went the route of getting a personal loan? I guess they're kind of asking if they should get a personal loan versus a business loan. I'm kind of getting from that.
Well, the bank people can pitch in here as well.
Yeah, Debbie or Robert have anything they'd like to pitch in there?
Yeah, I can add something. Obtaining a personal loan would be a much easier and much simpler process. Less financials. The money would most likely would get to the individual, the borrower, much quicker. However, there are advantages as well on the business side. But initially, I've seen where many businesses obtain assets on the personal side, whether that's with an equity line of credit against their home, and then later on, once they become profitable and generate the cash flow, that they are more willing to obtain a business line of credit or a business loan.
Doesn't that also mean, can you hear me?
Yep.
Doesn't that, then it also would mean they would have to be comfortable with having their personal assets be collateral as opposed to the assets of the business. So that would be a consideration. It may be a straightforward in some situations, but it might not always be a straightforward decision.
Okay. What resources are available to help a business operator improve their credit? Does anyone
Boy,
have-
this is a tough one. Banking people can again answer this one. I don't know how.
So I would say that's not something that we would be equipped to answer. I mean, it goes back to performance of on the personal side of paying bills on time. And there are organizations that help people with improving their credit scores.
Okay. Yeah, it's not really something that SCORE does either.
No.
I have a follow-up to the previous question about the personal loan versus the business loan. They're saying, for example, as a business partner, if the person could get 250K through a business loan instead of 100K through a personal loan, then it could be worth it. But is that normal or possible?
Personally, I can't speak to the normality of it, but if it's possible, then it's likely possible. So
Yeah, if the business supports it, of course.
exactly, the cash flows of the business would need to support it.
Okay. That might be something they need to sit down and have a conversation with experts about, yeah, you know,
Right.
so that the
And-
other,
And to be able to talk through the specifics.
yeah,
Yep.
yeah. Okay, great. I am not seeing any other questions posted. So, I don't know, Robert, Debbie, did you have any closing comments?
So somebody just asked, what is the cash flow ratio
Oh.
that's typical expected for a 100,000 loan? So that's something Robert and I can answer. I'll start. So the way the bank looks at the ratios of debt service is we would take the $100,000 loan, calculate what the debt service is going to be on a year, and we would want to see the number that's called earnings before interest, taxes, and depreciation to cover the interest expense by 1.2 times. So for example, on a 100,000 loan, let's say the annual interest expense would be 10,000 a year. The bank would want to see that EBITDA number, earnings before interest, taxes, and depreciation, covers that service 1.2 times. So that would be $12,000.
Great, thank you. Okay, I don't see any other new questions. Did you guys have any other closing comments before we wrap it up?
I don't think so. I can just say that Robert and I are available to people if they want to talk through a specific scenario that they're facing. I can't promise you we can help, but we definitely try, and we probably can refer you to somebody who could help you if we can.
Great, thank you so much. Okay, well, I want to encourage you to keep an eye on your email, and I will include the recording and the links that were shown in the slides today for you to refer. And let me grab that name here from the text for. And okay, great. Thank you everyone for coming today, and have a good rest of your week.
Thank you.
Thank you.
Thank you.